Good weekend to all. It's Adil bringing you a review from an intermarket analysis perspective, a old school way of trading. What Mr. Livermore obviously incorporated in his trading style. Okay, and many more. Okay, many more. It's intermarket analysis has become a reality. Obviously, or what should I say, was a reality without a name, and now it's become more of a name without a reality because there's very few that actually engage in intermarket analysis. Very few now, and that's basically how Paul Tudor Jones operated, and that's why he was so successful. It's obviously assessing a multiple array of variables and the cross correlation between them, and obviously trying to read between the lines in order to ascertain which direction the money is flowing, and by doing that we can obviously come to a conclusion that we're in a risk off or a risk on environment, and obviously we can trade accordingly. Okay, right, so where are we with regards to US markets, and what are the factors from a fundamental perspective and from a technical perspective that are going to move this market in whichever direction it goes? Because in essence, day traders, we're not bulls or bears. Yes, I do have a swing trading service, but that's slightly different. Even that's not a very long time frame, to be honest with you. But having said that, day traders, we basically go with the flow. Okay, we're like surfers. Whichever way the wave obviously takes us, we're more than happy to go. We ride the wave for however long we want, based on our obviously risk reward in terms of our stop loss, and then obviously we make our gains accordingly, and we can call it a day whenever we want, and we have very peaceful nights of sleep, because we're not worrying about a position gapping up or down the day after. Okay, right, so where are we fundamentally speaking? So basically the concerns that we have with regards to the market in the week ahead, I've already addressed this in my FTSE analysis video, so you're more than welcome to have a look at the FTSE 100 video, but basically just generally go through it quickly with you. Okay, so terrorism, as you know, it's all over the weekend press. Obviously that will obviously affect sentiment and morale, and obviously momentum from the outset. Okay, that obviously is going to cause a lot of concerns, especially with regards to terrorist threat increase globally. I mean, I was with my daughter on the weekend in the city centre, Manchester. Yes, I'm a Mancunian, and I support Manchester City, by the way, not the other side, not Manchester United, the glory seekers, as I like to call them. Okay, so basically there was a lot of police presence on the railways, buses, even in the city centre itself, and one of the things that I was contemplating was that Manchester itself was victim of terrorism by the IRA, and I remember I was playing cricket at the time. We were playing against Manchester Grammar School. We were actually winning at that time as well. I think I scored a 50 in that match. That's why I remember it. The fact that I actually scored a 50 as well. So I was batting number 3. I've always batted at number 3. Okay, so we heard this massive explosion, and I was in school at the time, and we were playing against Manchester Grammar School, and obviously we read in the papers later on exactly what had happened, that the IRA obviously had obviously attempted to terrorise the city of Manchester. Thank God Manchester's now a vibrant place with a lot of investment, and it's not the same what it once was, and in essence it's brought a lot of investment now, and it certainly has become potentially a second or third city to London, so it's certainly thriving. Okay, right, so with regards to the fundamentals, so terrorism, like I said, terrorism will be the outset that will cause risk off. Obviously money will flow towards the dollar, the yen, the franc, okay, Swiss franc, so, and that obviously characterizes risk off. So gold, watch gold move higher. Now we have got talk over Venezuela and Saudi Arabia working together to recover the oil market. We already know terrorism itself alone will obviously cause oil to spike because of the threat to supply. Obviously any increase in terrorism alert, etc., will generally cause money to flow towards gold and oil anyway. Okay, so watch out for that. So that, but remember that isn't exactly bullish. This is one thing that I actually teach my students, that the when you have a move in oil based on a geopolitical event, that's actually risk off. Okay, because as we all know, oil is the lifeblood of the S&P now and the FTSE 100. and even the French CAC to a certain extent, because oil stocks are very heavily weighted. So whenever oil moves, then the oil stocks generally move in tandem. But obviously, if that oil price movement is largely based on fear, and is based on geopolitical fear, especially in regards to terrorism-related incident, then the fear of fear in general, and the uncertainty in general, will cause the rest of the stocks to fall much larger in proportion to the oil stocks rising. So therefore, it's a risk-off scenario. Okay, and obviously it affects sentiment and momentum as well. So from this perspective, this is actually a negative. It's a negative, net negative. Okay, even though it will help the oil stocks or the commodity stocks, but it's a net negative. Okay, so that's basically what we see from the outset in terms of fundamentals. Then you have Grexit fears. So we've got reports from Syriza and the party, Mr. Siparas and Samaras. So to both individuals. Okay, and basically they are now both of them are turning towards a pro-austerity, which is quite strange. Okay, obviously we had Mr. Siparas on the one side, and obviously was in stark contrast with its opposition party, and now, given the fact that it's losing a potential election, it's shifted its bias now, or shifted its certain strategy, and now wants to be pro-austerity as well, which is quite strange, really, because obviously the Germans won't be accepting that, and they are contingency plans now for a Grexit, for Greece to actually leave the eurozone. So that again, those type of headlines are not exactly conducive to risk on scenario. It's a risk off scenario. Okay, so again, that's negative, net negative. Okay, so your terrorism related fears and Grexit fears alone are sufficient enough for the market to fall. What makes it even worse now is we have concerns with regards to the banks, especially Santander last week. Okay, and given the fact that we're organising this contingency plan for a Grexit, again, that's quite negative. Okay, then obviously we have the concern with regards to the US wages. Now we have Mr. Bill Gross now stating that the wage growth in the US is quite tepid. I mean, I've just retweeted it, so follow my Twitter feed with regards to his interview there. Okay, wage growth not enough to sustain US expansion. So if US is not expanding and is not carrying the weight of the rest of the world, then who is? Okay, and if you don't have any growth, then who's going to lift this market higher, especially if there's no QE? Okay, so that's certainly a negative bias, and given the fact that the market sold off post the obviously jobs report, even though it came out stronger than expected to a certain extent, obviously creating new jobs, etc. Wage growth obviously was tepid, therefore the market sold off, accompanied with terrorism fears, given the fact that those nutters, those loose cannons, fanatics, radicals, extremists, call them what you want, they don't follow any religion really, they have their own religion. Okay, and basically they go around killing innocent civilians, which is unacceptable in any religion. Okay, so these people basically need to be eradicated and uprooted and basically wiped out from my perspective, but that's just the world that we live in, unfortunately. Okay, and we have to deal with it. So that's the third issue, or should I say the fourth issue, if I can remember recollect correctly. Okay, the other issue as well with regards to fundamentals is the lack of QE from the ECB. Now they've obviously there were some reports of a watered down version of QE, where initially everybody expected 1 trillion of QE, which was obviously going to be solely the risk of the central bank or the European Central Bank. That's not the case now. What they're discussing now is a 50-50 split between national banks and central banks of only half the amount of 500 billion. So again, given the fact that stocks have rallied quite substantially, and obviously the only reason why stock markets are higher because of anticipation of this, I don't know, they've done so many bazookas now. I mean, what do you call this? A rocket launcher? Basically, God knows, I don't know. Basically, it's a financial, I don't know, what do you want to call it? I mean, I don't want to use these phrases of war because I'm sick of it. Okay, I'm sick and tired of war now, and individuals on both sides, but extremists on both sides of the spectrum talking about war. We should be talking about peace. So I'll try and use a peaceful term. But basically, the market expectations were for 1 trillion and for the European Central Bank to take all risk. Okay, now it's 50-50, and national banks have to take 50% risk, and that's not exactly very conducive to a risk-on type a rally or risk-on environment. So obviously expectations now have to be shifted from bullish to bearish, and that's exactly what's going to happen. Adding the fact of you got Grexit fears, you got terrorism fears. This is not exactly a good environment to be in. Now the other concern that we have in terms of fundamentals is the Russian economy. It was cut to junk status. Okay, So again, that's not exactly. I mean, Fitch downgrades Russia to triple B minus from triple B, outlook negative. That's not exactly a good sign. That's not going to be good for the Russian ruble, and we all know what happens when the Russian ruble starts to collapse. Okay, so these are all scenarios that we need to take into consideration when we are trading. Okay, so if you can see a bullish pattern on the markets from a technical perspective, that's not going to play out, unfortunately, because fundamentals are not confirming that, I'm afraid. Okay, so always align yourselves with fundamentals. If you can't blame fundamentals for misunderstanding the market. So, for example, if you state, oh, the stock market went higher based on weak fundamentals, stock market went lower on stronger fundamentals, and fundamentals don't matter, and so on and so forth. You can't blame fundamentals. It's your lack of understanding. Just because you're not educated in the field of economics, or you don't have a business degree, or you fail to understand the intricacies of the stock market or the economy, you fail to understand what retail sales means, you fail to understand what GDP means. Okay, that doesn't mean that doesn't work, or we totally ignore fundamentals now. I'm sorry, that's not the case. You must educate yourself, you must empower yourself to understand fundamentals correctly, and fundamentals clearly depict which way the markets are going. Okay, yes, I agree with regards to the theory of the efficient market hypothesis, and the market always 6 months ahead, and discounting all data and all news flow that's currently prevalent in the market, etc., etc. And all certain individuals are privy to news before us because they are on the VIP list, and the Fed sends them the information, say 2 or 3 days before, so they can front run the markets. That's fine. I totally agree with regards to a lot of that. Okay, but again, that doesn't prevent us from utilizing the bias at the time. So it's our ability to read between the lines. So, for example, let's just take this weekend for example. Now we all know that the ECB obviously has done half the QE that was expected. Plus, adding the fact now that we've got national banks taking the risk, that's an overall net negative. Okay, we have Brexit phase, it's negative. We have terrorism phase, it's negative. There's no conspiracy here, folks, okay? Fundamentals are not failing us here. Fundamentals are so clear cut, and it's telling us the bias is bearish, okay? So therefore, all we need to do now is realign our technical pattern to our fundamental view, and that increases our success rate, okay? So adding, and also another filter you can add, you add a fundamental filter, you add a technical filter, and the beauty of intermarket analysis is you add a third dimension. So not only are you observing, a lot of traders now unfortunately only look at the market through one eye, so they only trade on 1D. So people that are trading on 2D, so using technicals or fundamentals, when they look at people that are trading on 1D, it's like they're in the caveman. They're in the olden times. They're living with they don't understand what matches are or what gas is. They're living in a cave, in rubble, and it's Freddie Flintstone style trading. Okay, individuals that are trading with 2D, so fundamentals and technicals, those are educated in the field of economics, have a much greater view, okay, and a bird's eye view of the markets, and they're able to appreciate the news flow that comes out, and obviously the reason why the markets are higher or lower, and that gives them increased confidence and understanding, and they're able to trade the markets more efficiently and more effectively, and understand exactly what's happening with regards to every move in the market, and they're more superior intellectually, and in terms of obviously profit and loss as well, in terms of their trading, than those that are trading in 1D. And then you have the other individuals that are obviously on another level that are trading on 3D, so they're actually observing from 3 different angles. Okay, that's the beauty of it. Okay, and they have the ability to obviously have another filter in place to reduce the noise, because all these filters are reducing the noise. So the more filters you have, the more noise you filter out, and the clearer the picture becomes. Okay, and that's basically what's happening right now. We're trading intermarket analysis actually trades in 3D. It's a third dimension, and those that have watched the film Interstellar, which is quite interesting because it talks about dimensions and how obviously going to the, I think it was the 6th dimension, and it's a very interesting film, and the analogy can be done for trading as well. So when you're trading in the 3rd dimension, you look at those that are trading in the 2nd dimension, and you think to yourself, okay, they're 100 years behind us. These people haven't invented the computer yet. These people don't understand what charting is. These people are using pens and paper, or are probably still reading off the tape. So you look at them as barbarians living in the old age, and yet you are far, far superior in your understanding. And that doesn't mean that you're proud and arrogant, etc. No, it just means that you have privy to more information and more knowledge than those that are in the second dimension. Now there's also a fourth and fifth dimension in trading, and that comes with skill and experience, etc., and with time. Obviously, the ability to control one's concept or one's evil traits of fear and greed. Okay, I won't say evil for fear, but I mean it's basically the traits that lead us towards either overtrading or revenge trading, or lack of money or risk management, etc., etc., which eventually lead us to obviously blow our trading accounts. So these are all factors that you have to take into consideration, and there's so many levels and dimensions of trading. But usually for intermarket analysis, it's the 3 dimensions, and this is the one that I like to propagate and try to encourage and try to educate people with my videos, and obviously with my charts and my website and my Twitter feed. So I'm constantly educating all the time. So I'm actually providing something. I'm providing an alternative. I'm providing a solution, not just ranting and raving. Okay, anybody can rant and rave. It's the ability to provide a solution and an alternative that counts. Okay, and there's no enjoyment and there's no success in being a couch potato or an armchair critic. Okay, it's your ability to navigate, and you're going to have good weeks, you're going to have bad weeks. Now last week was a break-even week for me. It wasn't a good week. The week before was a decent week. The week before was was not so decent. The week before was a fantastic week. So this is all part of trading, folks. There are times when the markets are going to be in accordance and rationally and logically very clear cut, and there's times when the markets are very irrational, very illogical. Last week was very irrational and very illogical price action for the market. Stock markets were totally ignoring negative news, totally ignoring Brexit, ignoring terrorism fears, and the markets were moving higher on some false recycled letter from Draghi, and short squeezing higher in anticipation of this 1 trillion QE utopian save the market type policy. So, and that wasn't obviously, that when reports came out that wasn't the case, obviously then the market started to fall again. So again, I'm not going to go into every single day of last week's price action. That's what the live analysis service is for. If you do want to understand the markets and you want to learn and educate yourself, then the live analysis service is for you. It's not there for making points, it's there for educating, empowering yourself. That's why you should join the live analysis service first and foremost. Okay, so always remember that it's there to educate and empower, and that's what these videos are trying to do. That's what my website does, and that's what my Twitter feed is all about: educating and empowering people, offering the skills and the knowledge that you've learned and passing it on, hopefully to the next generation, so this oratory tradition, this scholarly tradition can continue. That's exactly what my teacher did, and that's what I'm going to do. Okay, and that's my motive for continuing to do this. Hopefully I will be in the next month or so, hopefully I'll be set up in Canary Wharf area, and obviously I'll start to teach students there, hopefully, if everything goes to plan. Everything is looking good so far. Hopefully a contract is going to be signed soon, so that'll be good. Okay, and hopefully I'll be able to help more individuals, and hopefully I'll be more one-to-one people that want to travel down south, or people that do live down south, and hopefully that will be a much better and more efficient way of teaching individuals, and not that YouTube's any bad, but YouTube will certainly be good as well. Okay, so now going to our technicals, now that I've covered the fundamentals, okay, with regards to the US markets. Okay, so remember, with regards to fundamentals for US markets, yes, we are obviously concerned about Brexit, and we are concerned about obviously terrorism, but I think one of the biggest movers for US markets will be the lack of wage growth. Okay, so, and if you go to my Twitter feed, you'll see that I've tweeted with regards to Bill Gross, who really is regardless of what you think of him, he's a good economist, a good market educator from my perspective. Him and Mr. the other chap, what was his name at PIMCO? I forgot his name now. Muhammad Al-Aryan, yes, he's very good as well. Okay, so I certainly value and cherish their analysis and insight into the markets. Okay, so let's look at a technical picture now. So let's start with the S&P 500. Okie dokie, so let's see what's happening here. Okay, so weekly chart, as a lot of you individuals are looking at. Weekly chart, potential bottoming tail here. Having said that, the higher high is not exactly a stellar higher high, okay, and it certainly does indicate some type of weakness and a potential long tail doji there. The daily chart, okay, is the one that I'm interested in. This is the one that's going to be very interesting going into this week. Okay, so this right shoulder with regards to this H&S formation, okay, the whole concept is really, what is a H&S? All it means is you have higher highs and higher lows, When the market no longer makes a higher high and makes a lower high, it triggers a HNS, full stop. Okay, you can look at all the posh terms and all these individuals trying to glamorize it in their books because they want to sell them, etc., etc. It's as simple as a lower high. Okay, full stop. When the market fails to make higher highs, it means the bulls obviously have lost their appetite for risk. Okay, taking, and there are factors or variables in the market that are causing the markets to move in the opposite direction and causing either it's a bullish exhaustion, okay, or basically or the bears getting very greedy, okay, or the bears coming out of their hole because the environment is conducive to their operation, okay. So that's probably the best way of understanding it. So what we see right here now is we are into this fib 75% resistance is held, which I've constantly explained. The fib 75% based on Mr. Bulkowski's work. Those of you that are not on the website or not visited the website, certainly head down to his website. It's very, very good. His books are very good. His materials very good. His insight and analysis and his studies are very good. Thepatternsight.com, Mr. Bulkowski, go visit him. I mean, I respect Steve Neeson, don't get me wrong, okay, with regards to Japanese candlesticks, but I think he's certainly got overexcited, and I think he's commercialized it a bit too much. Anyway, okay, so we're here now, okay, so HNS formation, 1873 is your target. Very bold statement to make, okay, very, very bold statement to make. So again, we'll see. The market, obviously, if the market takes out the fib 75%, then we quickly, swiftly change our bias, full stop, okay. We're not going to be obsessed with one way of thinking or one thought process. Again, we're very fluid, okay. And I remember there was a quote on my website which is very, very interesting, and this is very pertinent at this juncture with regards to understanding the market, okay. And it states, "I became a winning trader when I was able to say, to hell with my ego. When I'm wrong, making money is more important." Okay. That's basically what it comes down to. Don't call the market a bull or a bear. It can switch. Just ride the trend. Okay. So that's basically what we're trying to do here. So this fib 75% resistance holds. Okay. Then obviously the bearish trend is certainly intact, and down we go with regards to this HNS formation. So the first obviously magnet will be gap fill at 2025, and then obviously we'll go back and test these lows down here at 2000. Now what a right shoulder must always have fundamental backing, i.e. a fundamental catalyst, and I think I've already gone through the fundamental catalyst with you. A Brexit phase, okay, a Russian economy phase, okay. We've got obviously bank runs now that are on the verge of starting, especially with the evidence of Santander last week, okay. US wage growth is no longer there, okay. Even though the Fed is starting to become hawkish and talk about rate rises, etc. That's not exactly a good sign. The stock market, the US stock market, has rallied on a strong dollar based on USD JPY moving higher, okay. And given the fact that now that the dollar is no longer strong because of this lack of wage growth, okay, regardless of how many jobs you create, if your disposable income or your real income is dropping, that's not exactly a positive sign, okay. So that's not going to help the economy go forward, okay. It's your increase in real wages and increase in disposable income that will sustain the consumer side of the economy, because 60-70% of the GDP is based on consumption, okay, or reliant upon consumption. So if that's no longer there, then how can you sustain a stock market that's going to go higher, especially in the US when you have no more QE? I mean, in Europe, yes, you can argue, okay, stock prices will obviously remain, the Draghi put is there. I mean, there's always a chance Mr. Draghi could increase it to another 500 billion, or do another stimulus package, etc., etc. One can argue in China as well, with a low inflation rate last week, that it could embark on another stimulus program or another QE program because their inflation rate is so low, etc., etc. But with regards to the Americans, they've fired all their bullets. They can't go back to QE now, not after all this, and the credibility of Miss Yellen being lost and so on and so forth. So, and given the fact that the wage growth is not there, again, that's a serious concern. Okay, so all those factors that I've explained to you, okay, all those factors combined together are certainly indicating for a bias negative. Okay, and obviously this 2025 gap and 2000 level potentially could be hit this week. Okay, and we'll see. Okay, again, we're fluid. We're willing to accept our bias change. If that 75% resistance breaks, then we certainly will switch our bias and go to the downside. Okay, now let's go to the 60-minute chart. Okay, 60-minute chart, we had an inverted head and shoulders formation here. It hit its target of 2064, as you can see there. I mean, almost perfection. It held that horizontal resistance line. Okay, and now basically we're in no man's land. Okay, absolute no man's land right now. Okay. Anyway, one could argue the left shoulder here, inverted head and shoulders. I'm not going to go on that basis because fundamentals are telling me that it wants to go lower. Okay, so what's going to happen then? Let's go to our 10-minute chart. Let's see if we can find more of a clue. Okay, so we had this downward sloping trend line. We get rid of that. Okay, confiscate that. This gap is closed. We confiscate that. Confiscate this. Confiscate this. Inverted head and shoulders is over and done with now, folks. So confiscate that. My main issue will be whenever you have a bearish catalyst on the stock market, the first thing you think of is, okay, technically what gaps need to be closed below. And as you know, on the S&P 500, you can see here the gap that needs to be closed is 2025. Okay, so 2025 is going to be one hell of a magnet. Now, are there any other gaps that need to be closed? Let's have a look. Let's just quickly draw our charts here, see if any potential other gaps that need to be closed. 230, 240, here we go. That's 230, that's 230. Okay, so we have another gap down here. So you have a gap there and a gap there. Okay, so you have two gaps. So you've got a gap at 2025 and then you have a gap at 2002. Now, talking about gaps, whilst we're on this topic, I'll give you a perfect example of a gap fill. I mean, look at that. Perfection. Okay, H&S formation. Okay, bang, gap fill. Okay, can you see how that, and what was the fundamental catalyst there? This is a trade that I took with my subscribers on Friday as well. I was actually short the CAC and I made plus 45 on the short side, which is a fantastic trade, by the way. Okay, basically what happened was a H&S formation. The gap, unfilled gap below. Obviously, as we already know as traders, that gap is always acting like a magnet. And down we went. Okay, down we went. So perfect example of how gaps need to close based on fundamentals. And as we knew, terrorism fears and Brexit fears, etc., all obviously accumulated, and obviously lack of QE, which I've already discussed in the start of this video, obviously led this market lower. Okay, so go back to the S&P 500. Watch out for those two gaps below 2025 and obviously 2000. Okay, so again, those two levels are going to be very, very important. Resistance on the upside, you're looking at 2062, 2064, like we already discussed, the inverted head and shoulders target. 2072 if the market decides it wants to be bullish again and there is an unfilled gap above at 2090, but we will come and obviously address that when the market does manage to change its environment to bullish again. At this very moment in time, this just looks like a bear flag. Can argue to me, and it looks like it wants to go lower. Okay, actually, one second, the market has started, so let's quickly fire up my platform here, see where we're trading. So that's basically where we are. Okay, interesting. Okay, so the FTSE futures have opened up around the 6500 level. The Nasdaq is open around the 4210 level. The Wall Street around the 17730 level. S&P 2042 level. DAX around the 9670 level. CAC around the 4180 level. The Euro stocks are around the 3050 level. Okay, the euro is gapped higher, lack of QE, more than likely the reason there. The Kiwi is gapped higher, the Aussie is gapped higher. Okay, the USD JPY is down, so that's a negative sign. Obviously, lack of wage growth and obviously increase in risk means the yen will start to strengthen. Hence the reason why the USD JPY trade is down. Euro JPY is flat. Okay, interesting. Very, very interesting. Very interesting. Okay, I'll discuss this later on with my subscribers on the live analysis service. So those of you that want my day trades, all you need to do is join the live analysis service. I charge £50 a month for that, by the way, and I give you real-time entry, exit, stop loss. I give you live commentary, or much commentary as I can via WhatsApp, and obviously I give you my analysis from a fundamental perspective, like I'm doing right now. And obviously a TA perspective like I'm doing right now as well. So each trade comes accompanied with that. So it's designed for you to learn and educate yourself and empower yourself. Okay, right, here we go. So gaps below, that's basically what I'm looking at a 10-minute chart. Now let's have a look at the Russell 2000, see if we can back that philosophy or that thought process. Okay, so you've got an unfilled gap below on the Russell, you've got a bearish engulfing candle, so therefore bias is down. Okay, full stop. You have an unfilled gap below here and here. Okay, so both are indicating lower. So therefore the Russell bearish, therefore that confirms the S&P 500 view as being bearish. The Dow 30, it's held a 75% fib resistance level, so therefore one must respect that for now. If that gets taken out, then obviously we change our tune if it goes past 17,900. Okay, let's have a look at the 60-minute chart on the Dow. 60-minute chart on the Dow at the moment, no man's land again. Okay, that's all I'll say. I'll call it no man's land. I can't really see anything happening at all with regards to that. Okay, so again, it's all about that fib 75%. Now, we always cross-reference that with the Dow transports. Now, the Dow transports to me look very weak. Okay, as you can see here, a double top scenario has been put in. Basically, what we're looking at now is a lower high on the Dow transport. So this is very bearish. Okay, and given the fact that that's classed as being bearish, therefore this will potentially go lower, and looking for a 200 MA target to be hit on the downside for the Dow transports. Okay, and this is going to be interesting given the fact that you've got the fib 60% for 50% holding, and the 20 MA is below the 50 MA, therefore bearish momentum in terms of moving averages. So the Dow transports is confirming, well, basically telling you that the Dow is going to be weak and global markets are going to be weak, so therefore risk off scenario. Okay, right, let's go to the Nasdaq now. Okay, let's see if we can quickly give you an insight into here. Daily chart on the Nasdaq, obviously we failed at the 61.75% fib. We put in a lower high. This is a lower high. That was your higher high. That's your lower high. This is not a good sign. Okay, this is not a good sign on a daily chart. 60-minute chart, where are we? Okay, inverted head and shoulders target was hit at 42.50, hence the reason why I went short with my subscribers. Once an inverted head and shoulders target is hit, the short squeeze is over and the sell-off resumes. Okay, so basically what's happened now, after the inverted head and shoulders target has been hit, we have an unfilled gap below, and that gap needs to close at the 41.60. So watch out for 41.60 on the downside. Obviously we've got this downward sloping trend line, diagonal trend line, obviously has been respected thus far, and given the fact that the market's still making lower lows and lower highs technically on a 60-minute chart, down we go. Okay, so I can't see anything untoward there. Now with regards to the Nasdaq, as you can see here, we put in a double top intraday or midday. Basically we failed at this 42.30 level, obviously failed to propel higher. Now we have this market closing around the 42.10 level, and from my perspective it looks like it wants to close a gap below, so therefore a risk off scenario. Okay, right, so let's go to the semicons just to confirm the move here. Semiconductors, as you can see, 10-minute chart is into resistance, intraday double top. Semicons have been quite bullish. The 200 MA is obviously holding resistance there very well in the semiconductors. The daily chart, lower lows, lower highs. This is not exactly a bullish sign, folks. Okay, therefore expect a risk off scenario. This is quite a thrust higher, and the move looks as if it's certainly coming to an end. So therefore semiconductors certainly look bearish. Now the biotechs, slightly different story here with regards to biotechs. There is a deal that's been announced with regards to biotech, some sort of takeover over the weekend, so that's something that we need to take into consideration. But the biotechs still are at the highs, so that's pretty impressive given the fact that the other two tech related indices are making lower highs. This is actually still at the high, so this certainly has the ability to make a new high. But having said that, the inverted head and shoulders formation has been triggered, the gap has been closed. Is there really any reason why this market needs to go higher? I don't think at this very moment in time. We look like, we may well have factored in that potential takeover. Again, something that we have to see and observe. I mean, I'm not the one who's going to be right, it's the market that's going to be right, so I'll allow the market to dictate. But this, from a technical perspective, looks exhausting. It looks like a bearish continuation pattern. Okay, I think I've summed everything up there quickly from a technical perspective, and overall the conclusion equals bearish. End of story. Risk on, risk off, wax on.